Okay, so in April 17th, UNH had a surprise earnings miss, which resulted in a major drop off in share price. So let's go back to United Healthcare Group. So that was this right here. And then later in May, surprise, surprise, the CEO resigns and they pull their outlook for 2025. So everything that could be going wrong is going wrong here. They had been, oh my gosh, of course I'm getting all these ads. United Health had been denying the fact that they were being investigated for its Medicare practices. And then in July, they admitted that yes, they are. They confirmed Thursday that its Medicare program is under investigation by the U.S. Department of Justice and that it's been working with the agency. Of course, they say that, they're complying with formal criminal and civil requests, but the company has full confidence in its practices and is committed to working cooperatively. Of course, they're going to make a statement like that, though. So everything seems to be going wrong. But then the most recent reason is they missed another outlook as they changed their guidance for the full fiscal year of 2025. They dropped it down. So 5 big dominoes have caused this stock to drop off down to $245 per share. So they have tons of things that are going wrong, and yet I'm still deciding to invest in this company because I am taking a very conservative approach to projecting their future free cash flow. That is the way that I like to try to project the intrinsic value of a company, is I like to look at their future projected free cash flows. I do that in 2 ways. I first find projected revenue. I use the analysts, I use the company's own revenue guidance, and then I look at their past performance. I use a combination of these 3 things to give me my forward revenue growth, and then I take the past free cash flow margin. Free cash flow margin is the percentage of revenue that they're able to turn into free cash flow, and I multiply their past free cash flow margin by their new projected revenue growth. But in this case, because of the reason for this revenue drop, they have been having compressed margins. So I'm not going to use their historical free cash flow margin in this case. So let's look at what went wrong most recently. So in their previous guidance in December of 2024, they stated that they would have revenues for the full fiscal year of 2025 of between 450 and 455 billion. That's their total revenue. They said their net earnings would be $28 per share, about $28.5 per share. Now, in July 29th, this is their most recent quarterly report. They have dropped their revenue expectations to between 445 and 448 billion, and then they have also dropped their earnings per share to 14.65. So they basically cut their earnings in half. So they are having major compression on their margins. So what is going on? Why are they having major compression? I have a tab here that talks about that. Give me 1 minute. And see, we have some comments. I guess I can actually take a minute to address some comments here. Oh, Chris. Hey, Ryan. Keep up the great comment. Thank you very much. Did I say comment? Keep up the great content. Thank you. Okay. So where did I have that? Bear with me, guys. So essentially, I'll just go from memory. 89% of their premiums they are paying out in the form of benefits. So this percentage is the primary percentage that you look at for medical insurance companies. What percentage of those premiums are they actually getting to keep? Historically, it had been hovering around 85%, but new trends in healthcare spending has pushed that percentage up. You want a lower percentage? Their percentage has been pushed up to 89%. This came as a surprise. A lot of healthcare expenses were kind of pushed back during COVID. People were finding excuses not to go out, not to go seek medical attention for certain things, and elective surgeries are a big part of that. But in the aftermath of COVID, as things are returning to normal, we are seeing a spike in medical benefits being utilized. So a big trend right now is catching this company by surprise. Now, I would point out in their most recent quarterly report where they amended their guidance. They are saying that the company expects to return to earnings growth in 2026. So let's take a quick look at their margins and see how is it looking. So they're saying they're going to return in 2026. Okay, so on my spreadsheet right here, this is my automated free cash flow analysis spreadsheet. All I have to do is type in the ticker, type in a few assumptions, and I come up with intrinsic value calculations. So a big part of this calculation is the revenue growth. This is according to the analysts. So I paste in the high, the average, and the low analyst projections. We can see here that for 2025, the lowest analysts are projecting a revenue increase of 7.6%. That is assuming, this is taking into account their most recent guidance cut. However, when I calculate the company's guidance, okay, so in 2024 they had revenue of $400,278 million. In 2025, I took the low end of their revenue projection. That is actually an 11% increase. So I think that the lowest analyst projections are already starting a little bit too conservative, but I'm going to be utilizing this row of revenue projections for the most part for this analysis. I'm going to be ignoring the average and the high because there's a lot of risk surrounding this company, and so I want to be as conservative as possible. The next thing I want to point out is their free cash flow margin. This line shows their historic free cash flow margin. The gold line shows their average free cash flow margin. If the average from the past 5 years was going to go forward, then they'd be sitting a little bit over 6.5%, getting close to 7% free cash flow margin. So what I'm going to do is I'm actually going to adjust this free cash flow margin to drop down to the same profitability levels as 2024. So why is that? If I go to their financials, I look at their overview, and we look at their income statement, scroll to the bottom where it shows all of their margins, their free cash flow, their earnings per share. That's what we're looking for. Let me catch my train of thought here. We got to go to the ratios, earnings per share. Where is it? Am I looking over it? Must be looking over it. Well, maybe a better way to do this would be to go to their previous guidance. No, I need to be here. Where is their earnings per share? PE ratio, why am I not seeing it? I don't know why I'm having a hard time finding their earnings per share. Earnings per share, sorry about that. So in 2024, they had a diluted earnings per share of 15.5. That was fiscal year 2024. Their projected earnings per share in their most recent quarterly report is 14.65. So it's actually going to be a little bit lower. So I'm going to assume that their free cash flow margin in 2025 is going to be lower than their free cash flow margin in 2024. And so to build in that assumption, I'm going to reduce their average by 2%. And when I go to my graph, it's giving me a new starting point. So the red now is the average. The gold is my prediction. So it's now showing a reduced free cash flow margin. They stated that they are expecting to return to earnings growth in 2026. But to be even more cautious, I'm going to build in additional cash flow margin contraction so that over the next 5 years, their free cash flow margin continues to drop down to 4%. I believe this is incredibly cautious. Whenever I go to their historical free cash flow margin, let's go to the financials, income statement. I know where to find it this time. Free cash flow margin. Let's look historically over the last 10 years. I'm seeing over the trailing 12 months, we're at 6% in 2024, 5%, 7%, 7%, 7%, almost 8%, 6%, 6%, 5.75. And if I go all the way back to 9 years ago, they did hit 4.38% free cash flow margin briefly, but that seems to me to be an outlier. So I'm building in free cash flow margin contraction down to 4%, and it's going to stay there into perpetuity. That will be their permanent free cash flow margin that I am going with. So in my mind, this is incredibly cautious. So with that in mind, with the lowest free cash flow margin that they've seen in the last 10 years, forever. They never recover. And I also use the lowest analyst revenue projections. Then the fair share price, according to the discounted future free cash flow model, is $244 per share, which the current share price is $245 per share. So with all of these incredibly conservative projections, I'm seeing zero downside. If they just have like what seems to be like a worst case scenario situation where they continue to have margin contraction, they never recover, they continue to have revenue growth, which I guess I should speak a little bit more on the revenue growth. Okay, Chris says UNH will recover, but the short-term timeline is hazy. Not even mentioning the company drama, the oversight, the scrutiny is a tough hurdle to the bottom line. Not my investment cup of tea. 100% I hear what you're saying. It is absolutely a risky company, 100%. But in my mind, every company has its price. Like eventually it reaches a share price that is worth the risk. I've been watching this company fall from $600 per share over the last year. And at this point, at $244 per share, I'm ready to pull the trigger. So 100%, I hear what you're saying. It's risky. And I'm not going to be putting a major part or a major percentage of my portfolio into this company. So that is the next thing I want to showcase is, oops, sorry about that. I want to showcase this is my public YouTube portfolio series where I invest in a different company every week. I like to do a little bit of analysis and then do a discounted future free cash flow calculation and invest $100. So this will be the 29th company that I will be investing in. So you can see this is a small percentage of my portfolio. $100 is going in, but I think the price is right. So let me pull that up here. And actually, I got a little bit sidetracked. There was a little bit more I wanted to look at with UNH. So one of the big red flags that I look for is debt levels. I do want to talk about debt levels really quick. So it's incredibly important to me. Like debt is one of the biggest reasons that companies they end up having to take out more debt to service their existing debt. They have to issue more shares to bring in liquidity to pay off their debt. They dilute shareholders because of debt. It's one of the biggest reasons. So I always check what kind of debt maturity do they have coming up in the next 5 years, and do I see that as a potential risk? So another thing I like to look at is their interest payment. So if I go to their financials on the income statement, let's get back to the present time. The interest payment, where is it? Interest expense, $4 billion. Let's compare that to their pre-tax income, or let's look at their net income to common. So $4 billion compared to about $21 billion. We're looking at about 20% of their income is going to interest expense. So that's a decent chunk. But I also want to check what kind of big maturities do they have coming up. And you can see that in their latest. You can probably see it in their latest quarterly report, but I have pulled it up on their most recent annual report. So I can see in 2025, they have $4.3 billion due. In 2026, 3.6, 3.4, 3, and 3.5. And then thereafter, they have $60 billion coming due spread out over those years. So in the next 5 years, I'm not seeing any massive debt payments that would make it more difficult for this company to recover. So in my mind, I do not see their debt as a red flag. And when I also look at how they're spending their cash flow, this is another thing that's really important to me is, yes, I can figure out how much cash flow they're generating, but if they're not reinvesting it well, then it's not going to do me any good as an investor. So I can look at how they're using their cash flow in this section of their annual report. And I hope y'all can see this well enough. So they have a share repurchase program. In June of 2024, the board of directors authorized the purchase of 35 million shares of common stock. As of December, the board authorized the purchase of up to $33 million, 33 million shares, not $33 million. So they're doing lots of share buybacks. That's what I like to see. It's also a sign of confidence when you see a company increasing their share buyback. So I also like to look at the historic share buyback that they're doing. So let's go to the cash flow statement this time. Scroll down to the the investing cash flow right here. No, this would be under the financing cash flow category. This is the total. And right here, issuance of common stock and repurchase of common stock. So over the trailing 12 months, $11.5 billion they have repurchased in their common stock. And this is during a time when their share price is falling off a cliff. So all things considered, it's a good time to repurchase stock, especially when it's a low share price. And the fact that it's increasing every single year, in my mind, is a sign of confidence. It's not the end all be all, but it's a good sign. It's a green flag, if you will, that this company is more likely to turn around. If I scroll back to the historic share buyback program, I mean, back 10 years, they're only buying back about $1 billion, $1.5 billion. They up it to $4.5 billion, $5 billion, and then lately they've been increasing it quite a bit. So accelerating their share buyback program. How else are they spending their cash? They're paying a dividend. Let's look at their dividend increase. Common dividends paid. I don't know if we can see the percentage increase, but $7.7 billion over the last 12 months. If I scroll back to 10 years ago, it was only $1.7 billion. So their dividend has increased about almost 5x over the last 10 years. That's a really good increase in their dividend as well. And then the final big use of cash flow that I'm looking at is their pending acquisition. So as of December 31st, we have entered into agreements to acquire companies in the healthcare sector, totaling approximately $4 billion. So they're also putting billions of dollars into expanding inorganically as well as their organic growth. And once again, if I go to their cash flow statement, I can see cash acquisitions, 11 billion, 13 billion, 10 billion. So they're spending lots of capital, reinvesting into their company. What is their return on capital? That is another ratio that I like to look at. If a company is putting lots of money into buying capital, what is the return to shareholders? The return on capital is north of 10% over the last 10 years. So solid return on capital. They're reinvesting my money well. Historically speaking, that's not a guarantee that they're going to continue to do that into the future, but it is a good sign nonetheless. So good use of cash flow, no red flags in terms of upcoming debt. And on top of that, the company is so cheap compared to its intrinsic value when you calculate it based on its future free cash flow. So just to give a quick idea of what the upside looks like if Universal Health is able to turn around their profitability. So in this scenario, I built in a continual contraction and then it permanently sits there at 4%. If they're able to return to normalcy with a 0.5% growth in their free cash flow margin over the next 5 years, returning to about an average level. With that in mind, I'm seeing the lowest analyst projections in terms of revenue. Now I'm seeing a 100% upside. And then if the average analyst is correct, then I'm seeing a 182% upside. And that is on top of the 8.32% discount rate, which I'm just now realizing I forgot to bring up earlier. How did I calculate the discount rate? I didn't calculate it. I look it up on alphaspread.com, and I actually made it a little bit more conservative. So the way the cost of equity is the discount rate that I use. The way this cost of equity is calculated is they take the risk-free rate, which is the 10-year U.S. Treasury bond, it's virtually risk-free. So all of your investments should be compared to that risk-free rate. If you're not going to get a return greater than this, then there's no point in investing. So the equity risk premium, this is the premium return that you should expect for investing in stocks. You should get at least 4.12% on top of the 4.24. Now this company, UNH, has a beta of 0.88. This is the volatility compared to the overall market. Alpha spread will reduce the cost of equity if the company has less volatility than the greater market. Now, I'm not going to use that reduction. I'm just going to add these two figures together to give me 8.36. Looks like I actually need to adjust it. I had it at 8.32. Okay. So this is assuming, so just to clarify, $484 is a fair share price if I want a return of 8.36 per year every year. So this share price would give me this return. That's how this calculation works. But because the share price is so low, I have a 97% upside on top of This 8.36, you could also see this as a margin of safety. So earlier, Chris commented, UNH will recover, but it's a little bit risky for him. This is 100% understand. This is why I build in a large buffer. This is what I'm seeing as my buffer. So I've got a 97% buffer if this company is able to return to profitability over the next 5 years. They're saying they're going to return to profitability over the next in 2026. So all they got to do is pull it off in 5, and we're seeing a massive upside with the lowest analyst projections over the next 5 years. I typically will build in a 3% revenue growth after the analyst projections. The analysts don't typically make revenue projections past 5 years. So for years 6 through 10, I put in 3% and a perpetual growth rate of 3%. With those assumptions in mind, I'm seeing UNH as having a very nice buffer for me to invest in. Hokage says, did you get a chance to look at TDY SLB? No, I have not looked at those two companies yet, but as soon as I finish this, I'm down to look at them really quick. We can look at them together. I think that could be fun. I would like to start looking at companies on stream, live, just the initial quick look. I think that could be cool. So yeah, I'm definitely down to check those out with you. And then if time permits, HIMS and BTI, yeah, absolutely down to do that. Okay, so I was going to go ahead and show my portfolio as it is now. Let's swing this portfolio over here. Okay, so currently we have $3,776 invested. This is the portfolio, 29 slices. It is, let's filter it by most gains to most losses. So Hokage wanted to look at HIMS and BTI again because these are the two best holdings currently. We want to see, are they overvalued at this point, or is it still worth holding? That's a good question to ask. But if we scroll down here to the very bottom, we can see the red companies. I've got a few that are down 3-4%, and then these are the ones that are actually having some significant losses. Corpay, Accenture, Akame Technologies, Iridium Communication, and Simply Good Foods. Now, I still plan to hold on to these. I don't see these companies as bad investments yet. I'd like to hold on to them for at least a year and then revisit a couple times and see, do the future projections start to tell me a different story from when I originally invested? That is the main reason why I'm going to sell a company, is if I run this same analysis and I'm getting a different result. If I'm not getting undervalued anymore, if I'm getting overvalued, that's typically when I sell. It's not going to be based on have I made money or have I lost money on the company. So let's look at HIMS. If it turns out that HIMS is now grossly overvalued, then I would strongly consider selling. Now, it hasn't been a year, so I also have to factor in long-term capital gains versus short-term capital gains. Waiting a year can sometimes make sense, even if you think a company is overvalued, because if you're right, you have to be right by more than your tax rate. So your gains are going to get cut by 20%, 12%, whatever your marginal tax bracket is. So you got to take that into account. So for this week though, UNH is my 29th slice. So I'm going to go ahead and click on it, and we are going to buy some shares. So, well, not some shares, part of a share. So like I said, I put $100 every week into, I try to do a different company. It's not always a different company. Sometimes I will revisit a current company if I see that it looks to be a better value than before. So we'll hit buy. Confirm. All right, there it is. So first thing in the morning, tomorrow I am buying United Health Group. It's looking like it's going to be about $245 per share. So that's right in line with my worst case scenario. So we are done with UNH. Okay, so Chris says, well, not necessarily risky. The timeline, I see better investments in the shorter term. Okay, fair enough. Until the uncertainty goes away for UNH. Still great value for UNH currently. SLB looks really good, undervalued, beaten down energy sector. So I would caution that if too much uncertainty goes away, the stock price is going to account for that, and it's going to gobble up a lot of the gains that you could miss out on. So just keep that in mind. But yeah, I mean, 100%. There are tons of opportunities out there. You make a really great point there. I believe that you should ignore 99% of stocks. There's no reason to focus on companies that aren't just perfectly in line with what makes you feel good about investing in them, your investment thesis, the companies that you feel like you have strong conviction in. There's really no excuse to go outside of that realm of high confidence to invest. Like, there's no need to do it. It's really, there's just so many options out there. You can infinitely spin your wheels and spend more and more time researching more and more companies, and eventually diminishing returns are going to set in. So I 100% understand that perspective. So let's look at TDY. Let's start there. TDY, Teledyne Technologies Incorporated. So overview, I like to start with the overview. Let's look at the year to date. This company is looking strong on the year. Let's zoom out a little bit more. Looks like a pretty consistently growing in share price company. Market cap 25 billion. That's good. I like to invest in larger companies. I see them as less risky. Earnings per share 18, PE ratio of 30, so relatively high PE ratio, but maybe not for the technology sector, maybe about average PE for the tech sector. So, okay. Next up, financials. I like to look to see if the revenue is steadily increasing every year, and for the most part, revenue has been increasing. Looks pretty good. I like to check the margins as well and the shares outstanding to see what kind of dilution we're looking at, and not too bad. It looks like what years are these? Between 2023 and 2020, a little bit of share dilution, but over the past couple years it looks like they've actually been buying back shares. And then in terms of margins, looks like solid margins to me. So far I like what I see. After this, I like to put the company in my spreadsheet and see the automatic red flag analysis that I do, which I did not showcase for UNH. I should have brought that up. UNH, as a insurance provider, the way they call out their line items on their balance sheet, on their income statement, it's not the same as other companies like this one. Like, they have total revenue instead of revenue. So, like, just as one example, if I go back to the income statement, they have a whole breakdown for revenue. So it's more difficult for me to have my how do I say this? The equations line up nicely. I have to like build out like new formulas and stuff. So I haven't got around to that yet. So anyway, but with this company, I can do that. So balance sheet. Let's go back to the balance sheet. No. Okay. I like to scroll down to the total debt and see how is it compared to its total cash. So I'm seeing 2.1 billion total cash, 300 million. Not necessarily a bad thing. What was their earnings? Pre-tax income was about $1 billion. So if they wanted to, they could pay off their debt pretty quickly. So I think that looks pretty good. And then I also like to see how they're spending their cash. So if I go down to the investing and the financing cash flow, I can see that they are issuing some stock, but they have been repurchasing common stock over the last couple of years, and they've got a significant amount of money going to cash acquisition. So looks interesting. Ratios. I like to look at the return on capital and the return on equity. Now, I would say that these values are relatively low. So generally, I like to see a return on equity and a return on invested capital in the double digits. But this isn't necessarily like it's a little bit of a red flag, but it's not like what's the word I'm looking for? It's not going to eliminate it from contention just for that. So okay, so TDY. So let's go ahead and put TDY into my spreadsheet and see what red flags am I looking at. And also, I do a quick valuation check. So I just put in 0 on the cash flow margin, 0 on the cash flow growth, and leave 3% in there, and just see, like, with these very, very, very conservative revenue growth assumptions, what kind of share price are we looking at? And so based on a low growth, the share price is overvalued. So that's telling me that the market believes that this stock is going to grow in terms of revenue and free cash flow quite a bit. So, and that could be the case, which would make this company a good investment. But let's not get ahead of ourselves. I like to go to my Buffett supplement. So the cells that are highlighted green are green flags. Obviously, the ones that are red flags. And I'm not seeing any red flags at all. So in terms of Warren Buffett's balance sheet, income statement, cash flow statement, red flags, this looks like a really strong company. High margins. Their selling, general, and administrative expenses are not too high. R&D is not too high. Solid profit margin. Profits going up every year. Earnings per share, likewise. Inventory is going up at the same time as profit, which looks good. Retained earnings is consistently going up. I like to see that. Their debt is dropping while their cash flow is remaining pretty stable. That looks good. Their goodwill is relatively stable. Capital expenditures is low depreciation. Current ratio looks solid, so they have plenty of liquidity. Let's say just based on a financial strength check, this company looks really strong. So the only question left is what kind of revenue growth is going to make sense for this company. So without doing a deep dive, let's just take the analyst projections into account. Let's just take it at face value and assume this is what's going to happen. So revenue, they've only got 3 years of revenue projections. So that is a little bit of a red flag because I like to lean on the analyst projections quite a bit. I utilize, their opinions. They're the professionals. They do it for a living. So I think it gives me a good baseline. And when there's not a ton of analysts projecting cash flows, it's not ideal. But let's go ahead and put those 3 years in. And then I will fill in these last 2 years. So we'll just keep it in line with the top line there, 12 and 12. I'll go 5 and 5, and then 0 and 0. Sure. So with this in mind, if they continue to grow, let's say they continue to grow at a rate of 5% over the next over years 6 through 10, and I'll put 5% for years 1 through 5. So based on these projections, I'm going to say that this company looks like they're overvalued for me at this time. Now, a couple things I might need to tweak are the past free cash flow margin, and I might need to look a little bit more into what type of revenue growth is possible. When I look at the free cash flow margin, they did have a big dip here, which is bringing down the average. So if that is an anomaly, then the average could be a little bit higher. Now, on this part of my spreadsheet, I adjust the free cash flow margin based on R&D, CapEx, acquisitions, and stock compensation. So I want to talk through my logic on some of these real quick. So for R&D, I tend to give a little bit of credit. Now, a lot of companies, they're forced to spend a lot of money on R&D. Like let's talk about the iPhone, for instance. The iPhone, like the consumers are expecting Apple to release a new phone. I don't even know how often they do it. Is it every year? Is it every quarter? They're constantly having to release new phones. So there's a certain amount of R&D that they have to do. Like they have to be coming out with new products, or they're going to get outcompeted by Android. So it's like they have to. But I'm not going to count all of their R&D against them because I feel like their R&D does bring, some of it is an actual investment that's going to result in greater revenue going forward. So generally, I like to give some credit for R&D. And my baseline assumption is 10%. Sometimes I take it away completely. Most of the time, I just leave 10% in there. And the same goes for capital expenditures. Now, ideally, I would do a deep dive and I would look and see what percentage of their capital expenditures is maintaining their current property and equipment and their current plants, and what percentage is them expanding that I can attribute to future revenue growth. So generally, once again, I have an assumption of 10% for growth and 90% for maintenance. That's pretty conservative. I would say in most cases I would expect the percentage to be higher than 10%, but I put it in at 10. And then for cash acquisitions, this gets counted against because to some extent it's like a capital expenditure. This is going to bring in more depreciation in the future. So I count some money against cash acquisitions, even though it's mostly growing the company is how I figure it, but I like to count some against. And then stock compensation, I've been counting 90% against. And let's look at this company as an example. So let's see. Teledyne. And do I have any comments? I should take a quick break. Do you have a strategy on buying companies like Joby or Palantir, which don't have positive free cash flow yet? I do. I have not looked at Joby, but I have looked at Palantir, and I'm not going to say that I do a good job with companies like that. It is tough because their margins, I mean, margin is like everything at that point. It's really hard to know. For me, it's without expertise, it's hard for me to know what kind of margin they're going to end up at. I can look at industry standards and put a guess in there, but to use NVIDIA as an example, NVIDIA's margins are insane. Like I would have never guessed, like their free cash flow margin, if I remember right, it's up at like 40% or something like that. Let me just pull that up really quick. NVIDIA. Oh, and there's Palantir actually. So we'll look at Palantir as well. So yeah, on the income statement, free cash flow margin, where is it? Yeah, 48% over the last 12 months. Like, you look at their historic, okay, they had 39% here, but historically they're averaging like maybe upper 20s. And then over the last 3 years, once their data center segment popped off, their margins have just gone through the roof. So that's the sticking point for me, is what are the margins going to do? I feel confident most of the time with the analyst projections for revenue, but margins are tough. So, okay, where was I? For Teledyne, let's look at their cash flow and let's look at their stock-based compensation. So Teledyne is not a major offender here. So maybe this isn't the best example, but so their net income is $859 million. And when they calculate their operating cash flow, they increase this figure by their depreciation, because depreciation is a non-cash expense, and they also increase it by all of these things really, but I'm pointing out stock-based compensation. So this wasn't actually cash leaving their hands, they were just giving their stock to their employees. Now, if they turn around and they repurchase that common stock, well, now they're taking cash and they're buying stock. So it's like they're still paying their employees, but they're getting extra credit on their cash flow. And they're getting extra credit on their repurchase of common stock, because this looks good. Like you look at this number and you're like, oh, nice, they're buying back stock. So like in your mind, it's easy to look at it and be like, oh, that's points for them. But if I scroll up and I see, let's just say hypothetically, it was exactly the same. So their repurchase of common stock is 163 million. If I were to scroll up here and see stock-based compensation, 163 million, I'd be like, well, okay, they're not really getting, I shouldn't give them credit for either the extra cash flow or the stock-based compensation. So that is where this sell comes into play. Now, why am I not taking 100%? Well, I feel that stock-based compensation is a superior form of compensation because it aligns the interests of the employees with the success of the company. So I feel like it's better than paying them in cash, but I don't want to give them credit, for very much of it at all. So I count 90% against, and with those adjustments, I get a new free cash flow margin. So the average is 12.77. The average that I was using is 14.6. So if I was doing a deep dive, I might actually reduce this free cash flow margin by 2%. But let's just say hypothetically, these 2 years were an anomaly, and in reality, they're closer to, say, 17%. Let's say that we're wrong on the margin. Let's give them credit for an additional 3%. Even with the boosted free cash flow margin, I'm seeing this company still looks like they're overvalued. So for me to buy this company, I would have to be supremely confident that the highest analysts are correct in this case. And so I see this company as a little bit too risky. And again, this isn't doing a deep dive, so I can't say that I'm confident in their projected, their forecast. But I mean, these are the analysts. So another thing I like to do, as we're doing a little bit of it's getting deeper and deeper. So I like to look at the actual analysts. So let's see, analyst performance. All right, now there's a button. Okay. Oh, here we go. Full analyst rating history. So this is another thing that I think is interesting. So it shows the analyst success rate and the date that they made their in the most recent projections. So if there's a bunch of really old projections, then it's not going to be very useful. So if I look at the most recent ones, and these are relatively strong ratings right here, 4-star, 4.5 star. I'm seeing a rise in price target and a rise in price target, a hold rating, and a strong buy rating. So, and then here's another analyst right here, also a strong buy rating. So the recent analysts are looking really good, but let's filter by 4-star analysts only. Well, let's do 5-star. Is there any? There's not any. Okay. No one's perfect. 4-star analysts. The only 4-star analyst to give a recent projection is Kristen. And they're saying 580. The current price is 550. So, I mean, it's not horrible. But yeah, my stance right now is that Teledyne looks a little bit overpriced for me at this time. So, okay, back to the comments here. Okay, no new comments. So I think, guys, I'm sorry to say it, I'm running out of time. It is, I feel like an old man saying this, but it is getting close to my bedtime. I've got work tomorrow, so I'm going to call it here. But I do want to continue doing a live stock analysis. And maybe I went a little bit too much with Teledyne. Okay, Chris says on his watch list, DVN, EQT, CHDN, and AMAT. Didn't I invest in AMAT? Anyway, I need to stop chasing butterflies here. So, okay, yeah, I do want to continue doing live stock analysis. Maybe in the future I won't spend as much time on a single company. That way we can fit a few more in. I think that would be fun. But yeah, I had a great time streaming. Thanks for tuning in, guys. Hokage, Chris, Farland, if you're still around. I appreciate y'all coming in. Hokage, thanks for going through this. I know it's not as you planned. I really appreciate it. Hey, let's add it to the plan. I'm completely down to do some more live stock analysis per y'all's recommendations or y'all's suggestions. So, it's fun for me. If y'all enjoy it, I'm down to keep doing it. So the plan is to stream every Wednesday at 7 to 7:30. We'll start in that window. I'm curious if y'all like that starting time, if y'all like that. Oh, the time zone, Central Standard Time Zone. So yeah, let me know in the comments if y'all like that time or not. If you like the day of the week or not. I'm curious for y'all's feedback because, and what time zone y'all are in. So anyway, that's all I got. We'll catch y'all next time. And if I can figure out how to close down the stream, I will. There it is. All right.